All right. Ah. Oh, I see. Sorry. So I'm just kind of getting organized. So I'll get started in a sec after I kind of remember what I'm supposed to do here. Okay, got it. All right. So what I'm doing right now is just setting up the DCF, and I will. Okay. So let's see. We have the template, and this is something where you would do it often when I was in banking as well. You just get a template and then you kind of build off of it. You can't always do this because depending on the client and the information you receive, it might just be best to really just start from scratch. But this is pretty much everything we're going to need. What is this? And these X's on the side, basically they allow you to get to each section pretty quickly. All right, so what I need to do is get some data. All right, we'll start from 2010 and go to 2021, get actuals. All right, information loading. So if you guys have stayed here from the beginning of the stream, major props to you, because we just went through a ton of stuff that was kind of irrelevant, and so we're basically starting from scratch. And I'll try to finish this with, I think this will take me about an hour to do, and I'll try to finish this quickly as I can. So right now what I'm just doing is pulling historical data. Go to the income statement. So from 2013 we have all the figures till 2021. And yes, I do post this all on YouTube afterwards. So I know a lot of you guys are busy. If you guys can't stick around right now, feel free to head out and I will post this. You can view it whenever you have free time. COGS. Total COGS, operating, total COGS. $13,606 is what gross profit should be. Okay, perfect. All right, now we have the, okay, so we have all this information about the different types of expenses, but we're not really going to be modeling that out, so I'm actually just going to delete this. And I'm just going to simplify it by finding total operating expenses. Then our EBIT, operating income. Interest and income. This is always a little bit tricky to figure out which one it is. Let's see. Wait, but interest income. Actually, it's simpler. Let's see. Let me just double check. What figure we should actually be using. So net income should be 5644 for 2021. Over here. Income loss from operations should be 6523. So that's not that. Oh, that's this. 6523. Okay, that's right. Operating expenses total 7083. That's right. Interest income. So income, interest expense, other. So income before taxes should be 6343. And that is here. Six is 371 plus 135. Okay. Taxes. All right, so we got our income statement, all the figures here. So that is just what we're going to refer to a little bit later. DNA now. I didn't pull information we needed. Oh, dang it. I pulled the quarterly data. I need annual. I feel like I'm pretty quiet in this stream. Do you guys have any ideas of what to do to make it more interactive? Or I don't know if this is interesting or not interesting to you guys. Let me know if you guys have any feedback. Basically, it doesn't have to be necessarily what I like how to make it more interactive or anything, but if there's anything you guys want me to do either differently or something, let me know. Right now I'm pulling together the cash flow items, and these will be something that we'll need. This is also something we'll need for the DCF. What is this stuff? Oh, I don't think we need these. Okay, and then here for CapEx as percentage of sales. So, oh sure, explain each calculation. I can try to do a bit more of that. D&A and CapEx have a close relationship to each other, and so when you're projecting out, sometimes it makes more sense to have a zoom filter so it's easier to see the cells. Try zooming in. Also, if you guys change your settings to 1080p, I'm not sure if you're allowed to do that during the middle of a stream, but that could help also with the quality if it's hard to see. At least in the replay, I know that's something you can do. But okay, so in terms of, let's see. Yeah, D&A has a close relationship with your CapEx, and so that's why sometimes it's easier to model out as a percentage of CapEx if the figures are pretty consistent. So something like, let's say it constantly shows something like 20 to 30% a year, right? In this case, it's not as consistent, so we'll probably use something like percentage of sales instead. And CapEx as a percentage of sales, also very common. Usually you want to see something where the CapEx as a percentage of sales is pretty constant as well. It looks like for example, in these past 4 years, Tesla has a pretty relatively consistent CapEx usage of 10% of sales, except for this 1 year here. In the earlier years, as you can imagine, Tesla is ramping up their production facilities and manufacturing capabilities, and so that's where they're probably spending a lot more as a percentage of sales on CapEx. Change in working capital. This is basically just like what cash you're spending in order to kind of maintain the daily-ish operations of the business. And there's two ways to calculate it. It's either, it can be your percentage of sales or change in sales, since it's change in net working capital. And this will also depend a bit on, what you end up using will also depend a bit on what's more consistent. So, I mean, I'll kind of go through a lot of this a little bit more as I build out the rest of the DCF. All right, so now that we have all this information here, it's just helpful to have all of it organized so that you can just easily link to them. And purple, this is kind of just like some color coding that I learned at JPM, and it's what bankers do all the time. Is green means you're linking to another sheet. Black means you're just calculating. Purple means you're linking to the same sheet, so this one that we're already on. All right, and so what I'm going to do is I'm just going to link all the information first. Don't need that. Okay, and then DNA. Change in net working capital. All right, now what we need to do is actually estimate our next 10 years or so. So I think what we can do, we're going to look at the street case, have an optimistic case and conservative case. And to do that, we'll use a FactSet formula. Just steal it from my Shopify DCF. Okay, so this is just an estimate basically of what Tesla's DCF, what the street thinks Tesla's DCF is going to be. See how far it stretches out. And something that's really good to, I'm just going to compare against and see how reliable some of these projections are, and that'll determine which ones we actually use ourselves, and which ones we just completely rely on, and which ones we just kind of build out ourselves in terms of the assumptions. You guys will see what I mean. All right, so as you can see here, we have the sales estimates for Tesla and for all the different brokers, what are different companies that are covering Tesla, what the estimates are. And you can see they range quite a lot depending on the broker. And you can also see that there's a huge drop off after 2025. There's a lot less brokers who actually are projecting, and so that makes it less reliable, right? Because you want more consistency throughout. And so looks like 2022 to 2024 is relatively reliable, and 2025 is where it gets not too reliable. And so that's why probably also it was the same thing for Shopify, and we're just gonna not rely as much on 2025 onwards, maybe make our own assumptions, but 2022 to 2024 we will rely on a little bit more. And let's do the same thing for the EBIT. Oh, that's operating income. This is sales. 84, yeah, so dang. Tesla is expected to have a pretty massive jump in terms of sales. 56%, okay. I think that's it for FactSet. All right, so the street estimate is what we'll pull here. Same thing for EBIT. All right. All right, this is where things get a little bit tricky / interesting. Now we basically just need to figure out how much we want to be conservative or optimistic. And let me see what I did for my previous models, just as a frame of reference. Okay, yeah. So generally speaking, the next year, 2022, is somewhat reliable, as we discussed, because street estimates just have so many, so much access to, like Elon Musk, for example, and they can go on like calls regularly and figure out how much sales are are probably going to go up or down by. So this next year is pretty safe, but I do think we can be a little bit more or less conservative or optimistic. And so let's see. Let's think here. Ugh. $2022 revenue growth. So I'm going to decrease it by 10% and then in optimistic case increase it by 10%. Or like not okay, you'll see what I mean here. So take basically 90% of this, or in an optimistic case take 10% more. And 2023, I think we can do that for, well, let's see. So 56%, 31%, 20%. I think we want to be a little bit more aggressive in these years. And so let's see. So for here, in the conservative scenario, you can just see that Tesla has been, well, actually this is some pretty insane growth. 71% drops to 56%, which is actually like relatively, it kind of makes sense. And then a drop to 31%, because it's going from such a large base. This huge drop is actually not, it makes sense basically. But, there's also the argument that could be made that with a bunch of the supply chain issues, let's say they get fixed in the next 6 to 12 months or so, there is so much demand for Tesla products, and Elon has come out and said that they're limited by how much they can produce, not necessarily by demand, right? So I think it's okay to be a little bit more aggressive in the optimistic case. So let's say 15%, and then in the conservative case, I think it's not going to be a lot less than 31%. So I'm only going to decrease it by 10% there. And then in the optimistic case, I think we can probably, if they really overshoot it, or this is conservative case too. 10% here. In optimistic case, 15%, 15%. And even 15% could, I'm just going to make this super optimistic, 20%. And we have a range, so it'll be, sorry, I was thinking, it'll capture a wide range, so it's okay that it's like 20%. We might even make it a little bit higher. And then over these next few years, I think what we can probably do is just decrease up to a certain percentage, like what I did with Shopify. This is kind of like a very standard approach. Whoa. I guess I'll just actually build it. 2031 EBIT target or revenue target. Let's have it be in an optimistic case scenario, something like 7% or 5%. In the street case, let's grow it out to 7.5%, and then in the 20 optimistic case, have it at 10%. And then we're just going to linearly have it decline. So it's this is going to be a very, very simple model. And you could also argue that these figures, you know, the issue with the DCF usually, you know, you kind of lose a lot of imagination, for lack of better words, because like when Apple, for instance, when they came out with the iPhone, no one really expected it or could model it into their projections for a DCF, right? And then it totally changed Apple's entire trajectory. And you could definitely argue that for Tesla, they could introduce something like robo-taxis or the robots that they're making, and it could totally just change their revenue growth, right? So that's kind of the only issue here, but still a helpful exercise, the DCF is, in my opinion, just to get a rough sense of what you need to believe to invest at certain prices. Okay, so this is, these dollar signs do different like anchoring things, and I'm trying to make it so I can just copy paste this down. Yeah, cool. 10% sounds small in 2031, but just remember that you're growing off of like a much bigger base. And Apple, for instance, is only growing by like a few percentage points. So I would think that if Tesla's still growing at 10%, 10 to 15% in 2031, that's actually very solid. And we'll add our switches here. So this is like a formula that's pretty simple. Basically, it's just the offset formula makes it so that whatever number you have here, it'll take the cell below. So we're referencing N59, which is this cell, and then you link to how many rows you want it to go down. So if I change this to 2, then you can see it changes to the second row, and 3 to the third row. That's all that does. Very easy. Okay, and then we get to 251 billion revenue, which I think actually is fairly close to the street case that we had. Just to do like a sanity check, let's see what the figure was for the street. Total revenue by 2030, 327 billion, and this is our conservative case, right? So if we change this to our street case, 251 billion. Wait, this didn't update. Oh, it's because this thing's open. 328 billion by 2030. Just remember that, 328 billion. $314, 292. Okay, so this is a little bit actually conservative, which we probably don't want. Well, let's see what our optimistic case looks like. Okay, optimistic case is super optimistic. Okay, well, I guess we'll just get a wide range. Right, so then for EBIT, let's see. Best way to find all the info about your own company. How to find my edge in the market is a question that's being asked in the chat. Oh, that's pretty tough. I'll save time for Q&A later. Okay, for forward EBIT margin, 5.9%. Okay, I was just thinking about how to grow Tesla's margins, and Tesla's also going to become more of a software company, so I think you could definitely argue that their margins are going to increase meaningfully over time, and that's it. That is if everything goes well. Let's see what to do here. I think we could do a similar thing where we just are a little bit more or less conservative based off of street figures. And let's try these similar figures. Okay, so these margins are going to be pretty aggressive because it might not seem like a lot, but growing your margins from 17 to 22% in a few years is actually pretty hard to do. But that's why we also have these margin switches. So let's say you want to be really aggressive with revenue, but more conservative with your margins, and we can have that flexibility. And I'll kind of choose the assumptions that I think make the most sense later on. We're almost done. This is honestly the hardest part. Everything else is pretty easy. Okay, and then let's have this grow to so then this grows to, let's say, 20%. Whoa, this is weird. P69 minus, okay, we need to switch these. Nope, that's weird. Okay, so P69. Okay, so we're just growing this up linearly. And in the base case, let's grow it to, let's say, 22.5%. And then in the optimistic case, 25%. 25% for a car company is actually very, very high. So this is, I'd say, it depends if Tesla's able to become like a super, like high growth software-ish type company, but it'll always have those cars that could potentially lower their margins. Should I not add a column for 2032? Let's see. The goal is to project for 10 years, so don't need to add another column there. All right, and now we just figure out what our EBIT is, and then taxes. So it was at negative 17, 25, and 11%. This might be a good time to look at that thing I mentioned earlier about financial edge, if any of you guys are still here from the chat. But it kind of, one thing that you can look at is as you're building out like a DCF, is like the different, is the tax rate. Looks like they're assuming here just a typical 21% corporate tax rate. And the thing with Tesla is that because it used to not be profitable, the company was basically allowed to have what's known as net operating losses, and it allows them to lower their taxes in the future when they're profitable. But it looks like those operating losses should actually disappear, because you can see that that total is around 6 billion and they have a lot of profit now. So I would assume that Tesla's taxes are going to, in the kind of normal case, get pretty close to the corporate tax rate right now, which is around 21%. So for the street case, I'm just going to use a simplifying assumption, make it 21%. And then this is like kind of odd, but let's say you imagine that some, I don't know, presidential candidate comes along and he assumes that here he lowers the tax rate to 19% or something. And then for the that should be the optimistic case. And then for the conservative case, we have like a president who comes along and raises taxes, right? And corporate tax rate used to be like 35%, but now that it's at 21%, I think it'd be really tough, and a lot of companies would be against going back to something like 35%. So I think, let's see what the tax rate used to be. So it used to be 19.4%. Used to be like 40%. Whoa, that's crazy. Anyway, I'm gonna assume something like a 28%. And then we can just link that to here. Conservative case. Oops. Optimistic case. All right, we're almost there. And the only thing that I don't like about this assumption is that you can see that the tax rate is a little different, right? And if you want it to be really accurate, for 2022, you're probably not going to see a 21% tax rate. Like, the tax rate will change depending on how the company, if they're able to kind of like figure out ways to lower their taxable income. But it shouldn't change too drastically, and it won't really affect our end result too much. So let's just go with this for now. And then percentage of sales, or so for the cash flow items here, I guess what I did was I just took an average for Shopify, and I'm not going to sensitize this because it's like it shouldn't really make a huge difference either. The revenue growth and margins are really what's really important. So 7%-ish. Well, this is taking the average of the past 3 years. And CapEx, I'll probably do the same thing. Oops. Yeah, this is making everything super high level. So I'm kind of intrigued, or I want to know what the end result is going to be. You know that your DCF is roughly makes sense if your like street case or base case is close to the actual price that the company is trading at today. I mean, Tesla is a little bit overvalued, so that might not be the case, but we'll see. Okay, so cool. So it looks like in general the working capital for Tesla is pretty negligible, which is great because it just means that you don't have to worry too much about the assumption. So I'm not going to worry about that. Unlevered free cash flow formula is your earnings before interest and after taxes plus your D&A minus your capital expenditures minus your change in net working capital. And then we'll find our present value of our free cash flow. So gotta make our switches here. Oh well. So choose function is different from offset. It's a little bit more dynamic, I guess, but it has its other issues. But you can choose the number here or your switch, and then you select which one you want to choose, hence choose. So then if let's say I'll make this like 2, 2, or 3, 4, you can see that it'll change based on this. That's what that is. And we can go back to this thing from Felix, which I explained earlier is based off of, there's a link to this in the description below. You can use rareliquid Felix to get 25% off. But one cool thing about it is they have their WACC calculation here. And it looks like they're assuming that Tesla's WACC is around 11%. Let me just look at what assumptions they're using. 1.8% government bond yield. Makes sense. Okay. All right. So 11% is a little bit high. I think I will want to use that in my conservative case. I think something more like 10% for our street case makes more sense, and then 9% for optimistic case. Oh, oops, I put that in a terminal growth rate. That 9%, by the way, I was reading some, like this Morgan Stanley report, and they use a 8% WACC, which is super optimistic in my opinion. I think that they're doing it in order to boost the Tesla's price, which they're saying is around 1,300. So maybe we could change that later if needed, but terminal growth rate for conservative case, let's say 2%, 2.5%, 3%. pretty standard stuff. Okay, and then let's calculate the present value of your free cash flow, which is your free cash flow divided by 1 plus your WACC to the power of the year that you're in. So let's anchor the WACC. Okay. And there's something called mid-year convention, which you could do, and you could adjust your period and whatnot, but I'm not going to do that. So let's see. We got our... let me just steal this from the Shopify DCF I built. I have a feeling our share price is going to be very low based off the free cash flow figures I just saw here. Terminal value is, we're going to use the perpetuity growth method. So that is your last year's free cash flow times 1 plus your terminal growth rate all divided by your WACC minus your terminal growth rate. And then present value 1 plus your WACC to the power of your last year. The enterprise value is your sum of your free cash flow and your terminal value. 350 billion, which I think is really low compared to what Tesla's trading at. But okay, let's finish everything out and then I can adjust the assumptions. Debt, let's see what debt Tesla has. Accounts payable, deferred revenue, total capital lease, convertible senior notes, 1589. Okay, so they don't have that much debt. Cash and cash equivalents. Let me actually go into their filings. So current assets, 17 plus their marketable securities. So it should be 17,576 plus this 131. So this short-term marketable securities is like cash that they have, or investments that they made that are easily sellable. And then we saw here current portion of debt and finance leases 1589 plus debt and finance leases 5245. So equity value is your enterprise value minus your debt plus your cash. And then diluted share count. I wonder if Felix has this. Ooh, awesome. Yeah, they have their fully diluted share count. And so yeah, you can see here already how low our estimates are, because fully diluted market cap is 1 billion for Tesla, but our estimates are conservative right now, so we can also see what our super optimistic case says. Well, that's not right. Let me also double check something real quick. Basic share count is 1034 for Tesla. Okay, that looks around the right ballpark then. Okay, so we finally got to our figure. It's not the end yet because we're gonna have to make some changes. But so just link to this here. And the current price today, let me pull that information as well. $987.89. So then that is a 68% decrease, but right now we have a lot of conservative assumptions going on. So let's just take a look and see what the ranges look like. So if everything's super conservative, then we basically think that Tesla should be at $202 per share based on everything that we've built out so far today. If we have our base case, it's 366 billion, or $366 per share at 50 cents. And then if we have our optimistic case, we have $706, which is still below our current price. So if you believe in the assumptions we built out today, it kind of just makes it obvious that Tesla is overpriced no matter what assumptions you put in here. And I think this actually makes sense because Tesla is super overvalued from a fundamental standpoint, and I think this DCF kind of proves it, unfortunately. And I'm sorry if you're a Tesla bull. The only thing that I will say though is that there are assumptions we can make more aggressive. And for example, like let's try to make some of these assumptions even more aggressive, because I do think that it's worth seeing what the results look like. So let's say 25%. We increase the revenue growth for the here. So it's 62%, 39%, 26%. And then we grow this down, let's say, to something like 15%. And then for our margins, 25%. I don't want to go too much higher than that. So, but let's say that this is something like 27%, 27.5%, right? These I would consider fairly aggressive, like pretty aggressive. Like if Tesla hits these figures, it would be like a great success for the company. And based on that, if you believe on that, then we get closer to Tesla's current share price, which is $929. I do think that there's probably going to be new products that come about that really, like makes Tesla's share price or revenue growth a lot closer to this optimistic range than what's currently being priced into the stock. So I think like it's kind of like the same case with Apple. Like, do you believe that Tesla is going to come out with new products that really change the entire future of the industry, so many different industries? And do you think that Tesla is going to be able to create like a viable business model and profitable one as it builds out its ecosystem, right? In that case, then sure, Tesla could get to this more optimistic scenario in terms of the revenue growth, and also if they become more like a software company, their EBIT margins could stay relatively high. But if you're more of a Tesla critic, then personally for me, I think if I were to be generous, I would keep the revenue growth at the optimistic scenario. EBIT margin I would make base case. Taxes I would move to base case. WACC I would move to probably, it's a toss up between street case and optimistic case. Like let's say I'm being optimistic, then let's use our 9% WACC and terminal growth rate of growing at 3%. One thing I will note about that is that that's a pretty steep drop from like if you believe in the revenue growth of the aggressive revenue growth, this terminal growth rate of 3% is pretty small in comparison. So you could even argue that Tesla has a higher terminal growth rate that it should use. But in these scenarios, then you could argue, I would say with these assumptions, that Tesla's worth around $726 per share. Yeah, so I mean, based on all of this analysis, like what I personally would do is if Tesla ever I'm seeing something says rareliquid. You copied the EBT instead of the EBIT. Did I make a big mistake somewhere? I may have. Okay, G39. Ooh, great catch. But, oh, actually, I guess it won't really affect our information too much, but thank you for catching that. Yeah, so you can see it changes a little bit, but it's not really going to change it by much. Everything that I just said is still pretty much going to be true. And actually it doesn't affect anything, because we're not, like, even if I delete this, it doesn't actually affect anything at all, actually, because we're not really relying on these figures. So anyway, I think that if, let's say there's like some big financial crisis or something happens to the markets, Tesla drops to something like $500 per share. I think in that price range, it's probably on a fundamental basis still a little bit overvalued, but I would think that just with all of the brand recognition and, you know, the zealots for Tesla that exist, $500 like is a screaming buy for Tesla for me, even if it's a little bit overvalued. And so let's say, for example, we make everything our base case. Base case is saying it should be something around $366 per share. Around $500, $600, I think Tesla would still be a buy. At $700, I wouldn't blame anyone for buying it if you really believe in Tesla's like business model and in its success. But that's at the price range where I would say you're not really believing in the fundament, or you're not really thinking about a fair valuation, and you're kind of believing, you're relying a little bit more on your belief in the company. And then once you get to $900, $1,000 range, then you're like further down that spectrum. And so I don't think Tesla's a buy at $987. That's kind of like what this whole thing comes out to for me. I would want to be a little bit more conservative and buy when it's probably somewhere closer to like 700 or below if I wanted to buy Tesla. And the other thing I want to mention is that you may believe that there's so much that lies ahead for Tesla, right? And right now it's currently at something like a $1 trillion market cap. But even if Tesla, just absolutely blows things out of the water and it gets to $2,000 per share, that means Tesla's going to be a $2 trillion company, which is basically what Apple is kind of at right now. And in that scenario, you're seeing 100% gain in your investment, right? And it's a pretty risky investment to kind of put all of your money on for it to kind of double over, let's say, like 3 to 10 years or so. So I personally would just say that if you really, really believe in Tesla, or if you got in at a really good cost basis, then hold on to those shares. If basically everything besides that, I would try to have patience and buy in the 700s and below kind of range. Yeah, that's just my opinion. I know a lot of people are super have done way more research than me on Tesla, and DCFs have so many assumptions in here. There could be something that's something that's a little off, but this is a high level kind of analysis on everything. I hope it was helpful. Now I'll leave some time for Q&A. If you guys have any questions, feel free to put them in the chat. And for the next like few minutes or so, I'm happy to answer. I guess while you guys do that, the last thing is I wanted to just remind everyone that if you do want to get some data as you're just like trying to build out your own models and you're looking for a pretty cost-effective solution, Financial Edge, they sponsored this video, and they have these plans that are relatively more affordable, because I pay like $1,250 a month for FactSet, and then $700 something for a month for Visible Alpha. But for Felix, they charge like $50 or $70-ish a month for US dollars, and you can get information about the future estimates for companies, and you can have their WACC. There's also like all these other playlists where you can learn about like DCF valuation, all that stuff. So feel free to check them out, and you can use my code down below, which is rareliquid and you'll get 25% off when you buy. And I see some questions now. So he's creating a DCF model just for an investment banking analyst. I would say it's for any investor who wants to build one, I guess, or well, there's two things. So yeah, yes, a lot of bankers use it, and then second, for any investor who wants to get like a rough fair value estimation of their company that they're looking into. I'd say it's for those kind of people. Hello, I joined late. I wanted to know your thought on virtual internships. I mean, it could be a good resume booster, something to have on there. I think what's really important is hopefully you do kind of meaningful-ish work or get to know people that are good mentors to you. I think that's kind of what's more important. So my school has access to Bloomberg terminals. How would you best recommend using those services? Honestly, it's just kind of testing them out and getting used to how everything works. And if you do learn, it'll be very helpful if you do go into banking. You don't use it all the time, but use it time to time. Does this take into account Tesla's adjacent markets like energy storage, autonomous driving, and etc.? So this does not. It does to a certain degree. So, and it does in the ranges of your revenue growth. So if you have super aggressive revenue growth, then you're assuming that some of the revenue growth will come from things that are not baked into what currently exists in Tesla's business model. So that's where there is like a certain level of things that are not currently products that Tesla makes baked into the model. And the more aggressive you are with your optimistic scenario, for instance, is how much more you're kind of theoretically baking into all these new products that Tesla has not yet come out with. Could we do DCF in a large stable company? Yeah, I mean, I did do a few on other companies. If you look at, let's say, like Facebook, which is relatively stable. But yeah, I could try to think of some other like Apple or something. I think that could be a good one actually. This model is only available for Patreon members in the Terabyte patron tier. There's a link to my Patreon down in the description. And apart from the DCF, anything else frequently used by bankers? For valuation purposes, there's trading comps and transaction comps, and then there is LBO models, but LBOs are very, very specific for buyouts. Do you think IB is a good choice to start your banking finance career? Yes. Is what IB analysts build to advise clients? Yes. Do you know what the difference between a MC and finance? No, I don't. Okay, so Barry asked, hey, do you know if Tesla is actually paying taxes through the U.S. tax system? I do think that they're headquartered in the U.S., so I do think they're mostly paying taxes in the U.S. I think they recently just moved their quarters from like NorCal to Texas, I think. But yeah, with that said, I hope you all found this stream helpful, and yeah, thank you all, especially if you guys came from the very beginning and kind of stayed throughout all of this. And yeah, always appreciate the support, and I will stream again sometime in the future. You can follow my Instagram to get more real-time updates about everything. And with that said, thank you all for joining, and hope to catch you in the next one.